Good morning. It's Wednesday, the 25th of February. Here's what's on the agenda. Trump defends his economic record. Claude as collaborator relieves AI angst, but private credit fears build.
Lizzie, let's look at where we are on the European equity market futures picture then. Yesterday, stocks in Europe were pretty mixed, actually, by the close. Banks under pressure. Will that continue with private credit in focus? But European futures today looking as if we could see some upside. S&P futures pretty flat. Yesterday, we saw positivity on the back of that Anthropic demonstration as collaborator rather than disruptor, at least for now. Nothing too market moving from President Trump around State of the Union, but you have seen a little bit of upside in the oil price, perhaps linked to comments on Iran. We'll get to that shortly. The countdown to the opening trade starts right now.
Our nation is back, bigger, better, richer, and stronger than ever before.
The longest State of the Union address in history. US President Donald Trump, they're on a victory lap, a defiant victory lap ahead, of course, of the midterms later this year, Anna. But most importantly for our purposes, sticking to his guns when it comes to tariffs. So continuing the criticism of that Supreme Court ruling on his tariff agenda and saying that maybe the US is going to take in so much tariff revenue it will replace the modern tax system. So suggesting maybe there are more tariffs to come in the pipeline.
Right, so the focus on tariffs, and he was praising, of course, his economic agenda, criticising the Democrats around affordability. These are well-trodden themes. We've heard a lot of that before. And a lot of the Democrats actually, or not a lot, but some boycotting, setting up rival streaming events at the same time, trying to disrupt what was taking place in the chamber. I was looking for things that were moving the market, not a huge amount of evidence of that, a bit of dollar weakness, a bit of yuan strength, some people linking the two. Really on oil markets, we have seen a bit of upside movement on the oil price, and it's not particularly linked to what President Trump has to say, but he did talk about Iran. He did talk about his concerns there, that he says the administration there is building out its capacity around nuclear energy and nuclear weapons rather than reining it back as the conversations continue. Clearly, the market has been trying to put the emphasis on negotiation, but oil prices have been ticking up a little bit, so up by 0.6% just this morning.
Yeah, also promising that the federal government is going to match up to $1,000 in retirement savings for workers without 401ks. That's under an existing programme. It's not a new initiative. And then, curiously, changing his mind about Congress members owning stocks. Not really clear why he's changed his mind on that ban that he had previously opposed. OK, so we'll certainly watch out for that one.
Let's pivot to tech themes this morning, Lizzie, because we have Nvidia earnings out later. We'll come to Nvidia in a moment. There's lots of other things to talk about when it comes to the tech agenda. And yesterday we saw that US stocks were actually lifted. We turned a bit of a corner psychologically. Part of this driven by Anthropic and their demonstration, their workshop around Claude. Just what could it do? Their showcase. What would it do? Well, the emphasis in the reporting I've seen around this and from colleagues and from other outside sources seems to be this is a tool that, at least in the initial phases, and that's really important, but at least in the initial phases, is going to be very much about integration and collaboration rather than displacement. At least that is the line you can tell if you want to be calmer about AI turmoil, if you don't want to think that this is the end of all other software right now, that it's not about replacement right now. It cooled the panic, and that's what it did in yesterday's session.
Yeah, not quite the dystopian view that we got from that Citrini note earlier in the week. You could point to the platform that Novonesis built with Claude. So they had a 10-week report writing process cut down to 10 minutes. That's amazing.
Yeah.
And then finance as well. Every part of finance really could be helped by this Claude tool. You've got financial analysts, equity research, private equity, wealth management. The scope really broad. But let's also talk about the latest circular financing news, because you've got this deal between Meta and AMD. Meta spending billions on AMD gear. Interestingly, Meta buying AMD stock. So it comes back to this idea of circular financing. The questions to the AMD boss all about, is this the template for future deals? Why do you have to give this equity stake? Would they have agreed to the deal without a stock agreement, Meta? And she's saying, no, it's not a template for the future. But for Meta, really part of this aggressive front-loading.
Yes, and as we're digesting Claude and everything that it can do, I thought it was interesting that Relics, which owns LexisNexis, which is this legal software, software. They've added their Anthropic legal plugin to their existing AI provision. So again, underscoring that line that this is about collaboration, at least in the early stage, and rather than displacement. But you're right to mention AMD. That is certainly something that pushed up the AMD share price during the session. Nvidia is the focus for us later on.
Well, of course, the point of that deal is to try and catch up with Nvidia.
Right, exactly. So competition could be part of the narrative. But if you're looking for the positives, we have Pleydell-Bouverie coming up on the programme later on. And she got me very excited looking at all the ways that she is excited about 2026, to do with networking being an area that Nvidia can scale, to do with Hopper. You know, things are not dead for Hopper in any sense. Re-inflecting is the way that she describes that. Rubin providing a step change later in the second half of this year. So many reasons that we can get excited about Nvidia, but also thinking about competition. We will keep that in mind.
Yeah, we'll let Claire speak for herself later on, but she does say that the AI credit risk is low and circular financing concerns are overblown. Well, that's not what we've been hearing over the past 24 hours. A chorus of warnings about these cockroaches in credit building up, and again, it comes back to the AI theme. So you've had UBS analysts weeks ago laying out their own dystopian scenario, and now their outlook's even bleaker. So they say default rates could go as high as 15%, up from 13% less than a month ago. And it comes back to, if AI aggressively disrupts corporate borrowers, then private credit is the bit that's going to get hurt.
And the focus in the listed environment, the focus of this in the States is around business development companies, BDCs. So they're private equity, private capital businesses, private credit businesses. They lend into all kinds of companies, but software is the focus, of course, and their exposure to software is the focus. I think Claire does have some areas that she is worried about that link, so we'll certainly discuss that a little bit later on. But the latest BDC poster child, I suppose, and not one you want to be, New Mountain Finance, they've sold around $500 million worth of assets at 94 cents on the dollar. That has people asking the same kind of questions as they were asking a week ago with Blue Owl, where we saw them shuttering one of their funds, not allowing investors to take the money out. It raises parallels with the GFC, had me going back to 2007, August 2007, and BNP when it shuttered a fund. So all these kind of parallels with the GFC, a day after we heard from Jamie Dimon, really getting the market's attention.
And hearing from one of the players in the GFC, Danny Moses, the cheerful one, I think, in The Big Short, but saying that it reminds him of the years running up to the GFC. And you had the activist investor Boaz Weinstein warning that the wheels are coming off, again pointing to the Blue Owl moment, exposing deeper cracks in the industry.
One more positive to add into this chorus of negativity around private credit that we're getting is Dan Loeb over at Third Point. He's still launching a private credit fund in April, despite the unrest, and in fact suggesting that some of the unrest and the volatility around private credit could throw up some opportunities for that particular fund. So that's private credit. So far, so tantalising. Let's talk about the earnings stories.
Yes, out of the UK, we have breaking earnings from the drinks maker Diageo. Of course, the story has been that consumers have been switching to cheaper alcoholic drinks, so they've been prioritising volume growth over margins. They've cut their outlook, so it's really an early challenge for the CEO, Dave Lewis. They're struggling to revive demand in the US and China. This, of course, is the maker of Guinness and Johnny Walker, but they're saying they expect low full-year organic net sales to drop 2 to 3%. This is in their statement. They're also saying that they're going to reduce the dividend. OK, let's have another moment for some breaking news. We've got numbers coming through from Ofgem, which is the UK energy regulator. They're announcing a 7% reduction in the energy price cap. This is for the period the 1st of April to the 30th of June. This is according to a statement from Ofgem. The changes amount to a reduction of around £10 a month for the average household using both electricity and gas. It reflects the government's decision to take £150 in policy costs off annual energy bills. So this is just a part of that. I mean, the direction of travel has been well flagged. We've known about it for a long time, that the government has been trying to bring down these prices, and there have been levers they can pull to try and do that, and this is one of them. Well, let's tell you what else we've got coming up on the show today. We're going to be speaking to Ester, Baiget, the Novonesis CEO, of course, the Danish biosolutions company. We'll also be heading to Brussels to talk to Hans de Cuyper, CEO of Ageas, one of Europe's biggest insurers. Insurance notably on the list of Citrini's sectors that were most at risk from AI disruption. We're also going to be joined by Leonhard Birnbaum, the CEO of E.ON, which is one of Europe's largest operators of energy networks, energy infrastructure, infrastructure. And just after the European cash open, we'll dive into the markets with Naveen's Laura Cuyper. And looking ahead to the Nvidia earnings, we'll be speaking to Lion Trust's Claire Pleydell-Bouverie, who will be in the studio with us for a look at that.
Let's tell you what is coming up today on your trading day ahead. The German Chancellor Friedrich Merz is following a host of other European leaders in making a visit to China. It's certainly become all the rage. Nvidia earnings are due out 9:20 p.m. UK time, so that'll certainly be a story that leaks into our Thursday morning here in European time. But of course, we will have plenty of preview of that as we go through the programme. Also, after hours, we'll get numbers out of Salesforce. That, again, really interesting in the context of software and what AI can do. Paramount will be out with numbers, which is interesting in the context of a story we'll tell you about in the moment with regards to Warner Brothers and Fed Speak in Focus. The Fed's Barkin, Schmidt, Muslim will all be speaking today. There are in fact, we should talk a little bit about Germany, about Friedrich Merz on his way to China, or he's been arrived. On his way. He's arrived, and he's been giving, actually, before he left, he gave quite a positive take for somebody who's been quite hawkish on the risks that the relationship with China poses. But he's not alone in European nations trying to walk that really complicated line between a strategic rival and a trade partner.
No, of course, he's following in the footsteps of Emmanuel Macron and Keir Starmer, and preceding Donald Trump, who's going to be heading over himself. He's got separate talks scheduled with both President Xi and Premier Li. And as you say, it contrasts to the position that he previously took, more hawkish, but also to the position of Olaf Scholz, his predecessor, in his relation with China. He's not completely, bowing down to Beijing. He's still saying that there needs to be honest, frank discussions when it comes to overcapacity. Yeah. But clearly, given the US-EU tensions, looking further to Asia to warm up relations.
Absolutely. And Friedrich Merz has been, just like other European leaders, have been critical of China and the way it uses trade dependencies, supply chain dependencies, to try and drive policy goals. So exploiting dependencies around rare earths, for example, has been an area that has attracted his attention. Let's get up to date on some other news flow.
Yes, indeed. Other stories that you need to know this morning. The head of the European Commission says the EU will deliver a €90 billion loan to Ukraine, one way or another. Ursula von der Leyen was speaking in Kyiv after Hungary blocked the funding because of an energy dispute with Ukraine. Kyiv is set to run out of funds in a matter of weeks. Elsewhere, Bloomberg has learned that the Pentagon is threatening to use a Cold War-era law to force Anthropic to let the US military use its AI tools. Anthropic wants guardrails preventing its Claude system from autonomously targeting enemies or conducting mass surveillance. We're told Pentagon officials have laid out a series of consequences, including threats to declare Anthropic a supply chain risk if it doesn't comply by Friday. And Warner Brothers Discovery says a new $30 a share buyout offer from Paramount Skydance could lead to a better deal than its existing agreement with Netflix. In a statement, Warner says it isn't withdrawing its recommendation that investors support the Netflix bid, but it says it sweetened the Paramount offer does meet the threshold for further talks. So this drama goes season after season after season.
Season after season, absolutely. I mean, which season are we in? It started in December. It seems like we've been around the block on this one. I thought it's quite fascinating the way that Warner Brothers are playing this, though. They have this engagement, if we could use that term loosely, this sort of engagement arranged with Netflix. They're not ready to call off that engagement yet, but they are definitely putting Netflix on alert that they're still talking to Paramount.
Yeah.
And if Paramount has some very interesting and attractive things to say, then, who knows where that engagement with Netflix will head.
Reminds me of Emily in Paris, just going between the same suitors, back and forth, back and forth. But interestingly, did you see that Senator Lindsey Graham had Paramount CEO David Ellison at the State of the Union address as his guest?
Bringing visitors, bringing guests seems to be the thing that Democrats were doing on a number of fronts. But I mean, the underlying rationale for why this is happening is the cost base, the cost of streaming, all of that investment around streaming, something that these businesses, these studios in Hollywood know a lot about, and they've had to spend a lot of money, and now the pressure is there to combine, isn't it? And so no doubt there might be many seasons. We might be thoroughly bored of this by the time it gets to the end. Not yet, though. We will certainly keep an eye on that story. Coming up on the programme, HSBC shares have risen in Hong Kong trading after the bank's profit tops estimates, and the bonus pool rises to its highest in at least a decade. We'll bring you more on that and the top lines from the CEO, Georgia Hedry, who's been speaking to Bloomberg TV. Interesting in the context of AI and what it can do for banking and wealth management. He says they're not dialing back the number of graduates that they are recruiting right now. Plus, autonomous taxis may be coming to a street near you. Self-driving startup Wayve is raising $1.5 billion as it prepares to go up against US and Chinese rivals. We'll be hearing from the company's CEO, that's Alex Kendall, that conversation a little bit later on in the programme. And up next, we'll bring you top lines on earnings from the biotechnology sector. Novonesis is in focus as we speak to the company's chief executive, Ester. That conversation coming up shortly. If you have questions, if you want to get involved in these guest conversations, please do as the sun comes up over London. And it is sun today for a change. IB plus BBTV Go. That is the function on the Bloomberg terminal. This is Bloomberg.
We're just over 41 minutes away from the opening trade and not much doing in the futures picture this morning. Euro Stoxx 50 futures up about 0.1%. Stateside, you're looking at futures flat to the upside after that State of the Union address, of course, yesterday and in the early hours of this morning, if you're in Europe, from President Trump, kind of pairing gains when it comes to the futures picture off the back of that. But it seems like, Anna, this morning, futures shaking off the AI and tariff worries that we saw earlier in the
week. Possibly even a little bit of upside for the London market. We'll come back to that. Let's stick with the earnings stories, though, that could have an impact on individual stocks and indeed sectors. Let's talk about Novonesis. The enzyme business, the microbial solutions biotech business has reported numbers this morning. Ester Baiget is the CEO of Novonesis and joins us now. Ester, very nice to speak to you this morning. I wonder if we could start by talking about the outlook for the business. Your numbers for last year in some areas seem to be what the market was expecting. Maybe the full year number a little lighter than the market has expected, and the organic revenue guidance maybe a little lighter than the market had expected. So what's the overall message to investors this morning?
Well, thank you very much for hosting us and your time today. The overall message is 2025 was another good year, another strong year that we continue to deliver on our promises. 7% organic growth, solid, robust growth across all areas, across all businesses, growth mainly from volume, growth also with price, growth in all geographies, 9% growth in emerging geographies, and growth, profitable growth with 37.1% EBITDA margin expansion. And a year also where we continue to deliver on all our promises, continue to deliver on the integration, on track, 1 year ahead of track on delivering on our synergies, cost synergies, and well on track on the growth synergies. Also setting us with a strong start of 2026 in a good place for the year. With a guidance of 5 to 7%, including the impact of exiting certain countries of close to 1%, while we continue to expand EBITDA margin through the year. So delivering once more, and then setting us ready for the future.
OK, so let me focus on the future. That organic revenue target, 5 to 7% growth, you're suggesting you can achieve this year in terms of organic revenue. There was an estimate on the Bloomberg terminal a little higher than that. Maybe there weren't very many estimates and maybe they hadn't included discontinued businesses in there. But what will dictate whether it's more like 5 or more like 7?
Excellent. So in our guidance, we have included some consumer softness through the year. This is our view, that the consumer softness could be there during the whole year, particularly in North America, that could impact the consumer habits on the way that they go to stores and the goods that they consume. And although we are extremely resilient, we are not 1,000% immune to the final purchasing habits of the consumers. So we embedded in our guidance a softer consumer driver. Would that softness not be there? That would definitely be an upside and put us in the higher range or in the higher space. We have a winning formula or a very effective formula of winning, which is we are a pure biological play and we're present in more than 30 different markets. And we have shown year after year that this mode of operation, it's resilient and it drives compounded growth. So we're very confident that, that to be able to continue to embrace the volatility that we're seeing in front. That's why we're coming with 5 to 7%, and then continue to aim for the highest range as we've always have done.
Okay. Esther, the ingredients industry is in a bit of a rough patch. Investors seem to be more focused on top-line growth rather than profit generation. How are you making sure you deliver that?
As I said, we have been continuously delivering on organic growth, and it's volume growth mainly, but also from price, and it's a robust growth. We have delivered growth across all segments, and that will be the momentum also for moving into next year. Growth across all industries. And we see the pull from our customers and the consumers of the solutions that we bring in. We are enable cleaner label, healthier nutrients. We are a big enabler of high protein dairy solutions. We are enabler for solutions that lead to lower energy and consumption bills for the consumers. We are the enabler of solutions that lead to higher yield and efficiencies for our customers. So this underlying driver of demand, coupled with our resilient capability to produce and the strength of our innovation pipeline, that's what set us in comfort that we're going to continue to deliver compounded growth.
Do you think the protein hype is peaking?
We definitely see a strong pull and momentum for our dairy solutions, and it's across many different drivers. The main one and the strongest that has been there and continues to be, it's higher yield, higher efficiencies, higher productivity. Produce more with less, produce more in more effective way, or lower energy or higher yields for our customers. The high protein demand, it continues to be there, and we see it across all areas, but we see also the need for further differentiation. We see the pull for bioprotection to enable extended shelf lives and food preservation with clean solutions without the need of using preservatives or chemicals. And the combination of that, coupled with penetration in emerging geographies, will be the drivers of our growth. Bear in mind that in 2025, we grew in China in dairy, which is in a declining market, we grew. And that penetration on moving into more professionalized daily solutions, consistent performance, higher yields, high efficiency, yes, high protein, but also health. Those are the drivers. That's the value that we bring to our customers, and we are in a very good place there.
Esther, investors are asking in many sectors what difference AI will make, either for good or for bad. What's the most positive thing that you can tell us about what AI will do, the speed of innovation, the cost base, wherever you think it's going to be most relevant?
Exactly. Of course, we're applying AI in the same way that everybody does, bringing productivity and producing in the way we go to market and the way that we interact with key stakeholders and bringing efficiencies there. But the key beauty for us, for AI, it is on innovation. And AI is our friend. It's a powerful ally for us that makes even stronger our model of operation. So what makes us unique, it is we have a very strong R&D pipeline. We have more than 100,000 strains in our libraries. We have 50 million of enzyme designs. We have data for decades of how those solutions translate at the fermenters and then in the market. And AI is a powerful tool to combine them too. And because we have this data, we are in a better position to use the capabilities that AI brings. And we already see the efficiencies of that. We see a higher speed on innovation. We see more home runs for the same efficiency. We see us able to deliver breakthrough solutions that we could not do in the past without those tools.
Esther, thank you very much. Thank you very much for joining us. Ester Baiget, CEO of Novonesis, with a lot of positive things to say about AI and much beyond. We'll come back with some more earnings news. Ageas will be with us. Full year net operating profits beats estimates. Hans de Cuyper, the CEO, will be with us shortly. This is Bloomberg.
30 minutes away from the start of the opening trade, checking in on this futures picture, and it's a little brighter here in Europe, particularly in London compared to the US futures picture. It's only flat to the upside stateside, but perhaps that is weighed on by President Trump's State of the Union address, his continued enthusiasm for tariffs, and that, Anna, also boosting Treasury yields.
Right, so in terms of the bond markets, let's have a look at where we are on the European start of trading, and not a huge amount of movement. We are seeing some selling, some yields a little bit higher, and that does perhaps reflect a little bit of the draft coming through from Japan, where we have seen yields higher almost everywhere across the curve. In fact, yes, everywhere across the curve, but in particular at the long end, the 40-year up by 10 basis points over on JGBs. And this has to do with, yesterday it was to do with what the government thought about the BOJ's hiking policy. Today it has to do with appointments to the BOJ. And two people have been nominated as members of the BOJ who are known to be pretty dovish, associated with reflationist economic policy. So more fear of inflation in Japan has led to yields a little bit higher, in particular at the long end.
Well, let's get back to earnings now. One of Europe's biggest insurers, Ageas, has reported net operating profit for the full year that beat average analyst estimates. Joining us now exclusively is the Ageas CEO, Hans de Cuyper. Hans, thank you so much for making time for us. What went well for you this quarter? What are the main challenges you're seeing ahead?
Well, of course, we see a very volatile world, and stock markets are moving in all directions. We see a heavy reaction on all news related to AI. But we as Ageas, we are a very diversified group operating in Europe and Asia. And we have seen that the diversification helps us to report a very solid progress on our growth story and our profitability. So we can face this volatile world going forward.
Well, yeah, indeed, that Citrini report earlier in the week that reinvigorated the AI scare trade specifically pointed the finger at the insurance sector as a target for AI disruption. What have you been telling shareholders about your vulnerability to AI disruption? What have they been asking you about that?
Yes, well, exactly the same question, whether AI will be disruptive for our industry. I'm not too much concerned about it. We have 300 AI projects running around the world in our different operations, and the impact is becoming more and more material. We use it in call centers to improve our customers' service, and we see their productivity %. Or another area where we do IT programming, and AI is helping our IT staff, and we see their time savings up to 70%. So we are fully integrated the AI capabilities in our business model around the world. I do not see it as a disruptor for our industry, but an enabler to be a lot more in personalization of our servicing to our customers, and also to improve the work and the quality of work for our employees.
Hans, good morning. I wonder what you think of the market's nervousness around AI, and it's applied to a whole host of white-collar jobs, a whole host of services sectors, but insurance has been caught up in that. What is it that the wider market does not understand about the role that people will play or the speed of change in the industry that means that there is a bit of a moat around your business, assuming that is what you think?
Yeah, well, indeed, the speed of change, if I compare it with the development of technology and digitization over the last 20 years, and now the implementation of AI and data insights, the speed is a lot faster. Right? You have these short-term projects, 5-6 months, with immediate tangible impact on customer journey, on employee satisfaction, and on efficiency. We see AI as a co-pilot for our staff, and we are upgrading, we are training all our staff how to integrate AI in their job. I'm less a believer that AI tomorrow will fully transform our journeys in one go. It will improve bits and pieces of the process for the benefit of everybody. I mean, the cost per policy will be able to come down, and customers should enjoy that. Customer service will improve, but also I believe the employee engagement, and we see the scores in our employee engagement for the implementation of AI being very high.
Hans, can I ask you about the UK market? You've been expanding in the UK recently. How big do you want to get in the UK? What kind of exposure and why do you want to increase exposure in the UK?
Well, we have a very targeted focus in the UK market. We look at the private lines non-life business. That's the only segment where we are focused on. And after the successful acquisition of Saga's insurance business at the end of 24 and eSure mid-25, we are now a top 3 player in that segment. And in the market like the UK, which is highly competitive, size matters. And so we are now in a comfortable position. On top of that, with this, we have been able to build a unique profile because we are now active in almost all distribution channels in the UK. We were already strong in broker and partnership distribution. With eSure, we have now solid capabilities in the PCW market and the direct market. And I'm convinced in a market with such a price dynamic, being able to play with all the distribution channels is a positive versus our competitors.
And when do you get the integration gains, Hans, from the deals that you've been doing? I think 2028 was the target. Any sign that some of those benefits are coming earlier?
Well, the Saga benefits will definitely come earlier, but they are smaller. We are already writing all the new business coming from the Saga distribution network on our new future system. For eSure, you're right. We will have an integration cost of approximately £130 million, but from 28 onwards, we expect an annual synergy positive of £100 million. This year, 26-27, we assume that almost the full contribution of eSure will be invested into that integration, but that is on track. Synergies have been allocated, new management team is in place. So I'm very confident that our commitment for 28, and that means that our UK business should bring £300 million profit to the group, is perfectly on track at the moment, but don't expect a major impact for 26 and partially in 27.
Hans, motor pricing in the UK has been volatile. What are the headlines that motor insurance is facing here? The headwinds, excuse me.
Well, indeed, we have seen market softening in 25 in the UK. Honestly, I think it is too early and too fast because the claims inflation on the repair in the motor network remains high in the UK, and that is a concern for me. I have seen in the fourth quarter and the beginning of January the rates stabilizing a little bit more, and I think that's what the UK market needs. I think at this moment there is no room for further softening of the motor premiums.
Hans, you mentioned earlier that this is a volatile world, and you've structured the business, you designed the business to try and stand up to that kind of volatility. What is it about the volatile world that worries you and the business that is Ageas?
Well, if I would look at specific regions, we are very sizable in Europe and in Asia. If I would look at a regional level, then you have some concerns. In Asia, we are a sizable life insurance player when we live in a low interest rate environment. In Europe, we have seen interest rates go up and now I would say more stabilizing. We already spoke about the UK. And then, of course, we are also a player in reinsurance. And then the cat-nat, the natural disasters, is, of course, an attention point for insurers and reinsurers around the world. If I look globally as Ageas, as a group, I'm less concerned because we see that with the mix and the great diversification we have, both in business lines as well as geographically, you will see that our profit pattern and our distribution to our shareholders has been very stable and growing. So underlying a lot of volatility, but at the top, we are, I think, a very stable group with high solvency and solid performance.
Hans, thank you very much. Thanks for joining us. Hans de Cuyper, the CEO of Ageas. We thank you very much for your time. Now, President Trump has been delivering his State of the Union address. Everything is going great, according to the president, but the Democratic response offered a sharp contrast to the picture painted by the President of the United States.
Since this president took office last year, his reckless trade policies have forced American families to pay more than $1,700 each in tariff costs. Small businesses have suffered, farmers have suffered, some losing entire markets. Everyday Americans are paying the price.
A different take there then. That was the Virginia Governor Abigail Spanberger delivering the Democratic rebuttal. Much more on the State of the Union address and the tariff story later in the programme. This is Bloomberg. Welcome back. This is the opening trade, 7:44 here in London. So around 16 minutes until we open up these markets for cash trading. And the picture looks flat to positive, more positive if you're in London. The FTSE 100, the futures picture in London up by around 0.2%. Lizzie, elsewhere, some slightly more modest gains. And US futures, Lizzie, are flat to negative this hour. But we have some individual stock stories to focus on.
Indeed, we continue our focus on earnings this morning. We turn to energy now. E.ON set to expand its investment programme by an extra €5 billion through to 2030, with data centres and electrified transport increasing the demand for electricity. The German utility is looking to respond to mounting grid bottlenecks across the European continent. I'm pleased to say we're joined now by the CEO of E.ON, who is Leonhard Birnbaum. Leo, thank you so much for making time for us this morning. I want to start with this expanded investment programme. Just talk us through the reasons why you've chosen to do that.
Yeah, there is an obvious need for additional infrastructure. Infrastructure is just becoming a scarce resource across Europe, actually across the world, and it's actually the bottleneck for a further, continuation of the energy transition. And the drivers behind that are continued expansion of renewables, continued expansion of e-mobility, electrification of heat, electrification of industry, increase need for data centers, and that all combines to an increasing need for infrastructure and investments into them.
And your grid returns are guaranteed by the regulator, paid by customers. At a time of sensitive energy prices, how delicate is that?
Yeah, I think that is the balance that the regulators need to strike. To be very clear, a lack of infrastructure is more expensive than too much infrastructure. Too much infrastructure is basically not possible. And it rectifies itself with the growth of demand. So what we have experienced is that wherever we hit bottlenecks on the infrastructure side, customers had actually to pay more for them than they ever saved at not making the investments. So it's a good investment for customers, but indeed we need to strike the right balance that we build what is really needed and we build it in a way which is most beneficial for our customers. So and because it's not a one-year need, this is not a boom for 1 year or 2 years. I mean, we will need to expand our investment program for a decade to come. And therefore, we are actually quite confident that we will get a regulation which allows such an investment program over an extended period of time to really take place.
Leo, good morning. I wonder if you could talk a little more about Europe's electricity needs right now and energy needs, because for a long time we've been in a period where, yes, electrification and all the things that you just described have been pushing up demand, but gains in energy efficiency have meant that overall demand for electricity has not much increased. So what kind of step change are you gearing up for?
Yeah, we have seen electricity demand in kilowatt hours, so the energy consumption of end consumers being basically flat over the last years. So we have not seen a massive increase, whilst all predictions that we see going forward from really everybody are predicting a growth of 2 to 3%. In the US, the growth is actually even higher. They are mostly driven by data centers. Now, the fact that energy has been flat has not meant that we didn't have much additional need for new capacity, for new grid connections. And I'll just give you an example. if we are adding zero additional energy demand, but we are replacing coal stations by windmills and solar farms, we will obviously need more infrastructure to collect all that power, even though the power consumption is still the same. So more infrastructure is needed, but we anticipate now also going forward that we will see an increase, and actually we are seeing signs of an increase due to e-mobility and electrification of heat, not so much due to electrification of industry so far. And that should translate into more demand and more capacity requests and more infrastructure again.
Yes, could you talk to us about the different customers and where the demand is coming from? So Europe, maybe not quite so much about data centres as in the United States, but also you suggest they're not so much about industrial customer demand. What do you see on that front?
Yeah, so what we are seeing is that when it comes to retail end customers, B2C customers, we are seeing an increase. We are seeing signs of slight increases, which we think is mostly driven by a little part of it e-mobility and a little part of it is like electric heating, heat pumps, actually getting more and more mainstream. On the industry side, we have not seen an increase over the last year, so their demand seems to be pretty flat. And that in total is compensating itself, so therefore we are still flat. We would anticipate that if industry have seen a bottom, and actually industry demand is significantly down versus 5 years ago, then actually I think we are plateauing, then we should see an increase also in kilowatt hours. And that is indeed the prediction that is given by all the agencies.
Leo, I want to come back to EVs because the EU's new plans effectively pave the way for there to be more hybrid and combustion engine sales. How is that changing your plans for EV charging in Europe?
It's not really changing anything. I think in the long run, whether like e-mobility is at a certain level 2 or 3 years later or earlier, in the end doesn't really change the big picture. E-mobility is clearly in the long run going to be the main technology, and therefore our plans are not dependent on a certain set date of 2035 or not. We are looking at a macro trend, and the macro trend is clear. It moves towards e-mobility, and therefore we are not impacted by the discussions that have been taking place in Brussels over the last year.
Leo, thank you very much. Thanks for joining us. Leonhard Birnbaum, the CEO of E.ON, thank you very much for your time. We'll watch the E.ON share price, the Ageas share price, the Novonesis share price at the start of trade to see how all of those individual stocks perform. Taking a step back, though, getting a macro view of these markets, our Markets Live executive editor Mark Cudmore joins us now. Mark, help us focus back on the macro themes. US futures look pretty flat after a day yesterday where we saw investors trying to draw a line in the sand, Anthropic being cast as a collaborative tool rather than something that's going to destroy software everywhere. What do you make of the latest price action around equity markets?
I think that what we're seeing in markets so far this year, and really the last few months, is going to be the backdrop for the next long term, for the next maybe year, maybe longer. And what I mean by that is that the underlying story is incredibly bullish still. We have just fiscal stimulus happening around the world. We have easy monetary policy. We have an incredible capex bubble, but we're in the inflation stage of that bubble. Everything out there is super positive from a macro point of view. And the disruption we're seeing, that the supposed big negative, the bogeyman, is a risk of excess productivity, is a risk that things get produced too quickly, that there'll be too much wealth predicted. So therefore, there's going to be individual big losers. The volatility is going to get worse. The sector dispersion is going to increase. And I think that sometimes some of those volatility scares will have knock-on contagion effects they've not really seen now, that see a broader market big correction. But those corrections, even the bigger ones, will ultimately be bought quite quickly. I think the underlying market is going to get increasingly more volatile over the next year, while ultimately probably going a lot higher. But I'll also say that the theme of the rest of the world outperforming the US is the one that's really entrenched. I've been in that camp for more than a year, as you know, and I think it continues. I think it's a multi-year trend. We've talked about this since end of January last year, that we're in a multi-year trend of US underperformance after a 14-year trend of US outperformance. And so it's 14 years of outperforming. It can do many years of underperforming before we need to worry about it being an overshot trend.
Well, Mark, this is my first week on the opening trade of 2026, so tell me, where are you looking outside the US for opportunities?
Yeah, look, I continue to think the Asia story is excellent. I think that, one of the biggest impacts of the Trump administration is to really, restore China's place in the world and kind of help it boost its trade in Asia, help it boost its kind of its importance, help return its markets to investor focus. So I think, I'm not saying China itself, but because of China, it's all the derivatives in Asia that do really well. China stocks themselves, you need to be much more of a stock picker, and they're not actually cheap. I think Hong Kong's always the better way to play the China trade. I think Korea, it's really a two-stock story, but there's stocks that are going to continue to do well. So I think Korea will continue to do well despite over 100% over the past year return. I think Latin America is still really interesting. I think, things like Brazil still has the commodities that the world needs. So Brazil, Korea, Hong Kong, these are some of the really, really interesting stories. But I think there are many interesting opportunities. Many stocks in the world are not particularly expensive. US stocks are still expensive, and there are other expensive stock markets, but many stock markets aren't expensive, given that we've got a pretty good global macro backdrop. So it's that tailwind of spending from governments and AI companies and easy monetary policy is a very, very strong tailwind.
Okay. Mark, thanks so much. That's Bloomberg Markets Live Executive Editor Mark Cudmore. And remember, you can get up-to-date analysis and insight from Mark and his team by going to MLIV Go on your Bloomberg terminal. Well, coming up on the programme, it is the opening trade. Futures are pointing ever so slightly higher stateside, but here in Europe, they're up about 0.2% for Euro Stoxx 50 futures. Same for FTSE 100 futures. Outperformance expected in Italy, Anna, this morning. The underperformer set to be the DAX in Frankfurt.
We had banks under pressure yesterday, didn't we? So interesting to see if we get a change in that. Autos were doing really well yesterday. We'll see if we get any kind of change in that. So we'll watch for the market open here in Europe. As you say, US futures are pretty flat. President Trump not saying a huge amount to change the market dynamics in his State of the Union address. We'll get back with the market open, though. This is Bloomberg. Welcome back. A few minutes until the start of equity trading, cash equity trading for this Wednesday morning, the 25th of February. So let's have a look at where we were on the US session yesterday, what clues that gives us as to where we will head. Well, not a huge amount of a clue, actually, in the latter part of the US session. When the European markets closed up, this is where US equity markets were, and they've made some very slight gains on the other side of that, but not a huge amount, Lizzie. And so that gives us some sense of why we don't see a huge amount of upside perhaps coming through for European equity markets. Yesterday's session was pretty flat, pretty mixed, actually, I should say. So not flat, but mixed. So we had quite a bit of divergence at the index level. The AEX was doing pretty well on the back of technology gains. We had weakness coming through in the banking sector. We'll talk more about that and the links with private credit later in the programme. We had autos being an area of resilience, but all of that added up to a fairly mixed picture. So today things look as if they could be a little more homogenous, at least for now. The FTSE futures picture and the DAX futures picture look fairly in keeping with each other. We're expected to be up around 1 or 0.2% then, Lizzie, at the start of the trading day. What do you see in the individual names?
Well, a lot of focus on London stocks this morning, Anna. A couple of earnings stories to highlight for you. I'll begin with HSBC. They're already open in Hong Kong. The share's already up about 4%. This after HSBC beat on profit, so it's well farmed, boosted by client income. We'll keep an eye on them. Also on Diageo, they're cutting their guidance for the second time this fiscal year, indicated lower on Tradegate. And also watching GSK, so they've agreed to buy 35 Pharma, this biotech with an early stage high blood pressure drug, so really expanding into cardiovascular medicine for GSK. They're going to buy this Canadian firm for $950 million in cash, according to a statement. We're inching towards the open, Anna.
Yeah, absolutely. And the names, you're right, are all London focused, and that could put our attention on what happens on the London market. And HSBC, the initial reaction in the Hong Kong market was a positive one to those numbers coming out of the team of that London-based, of course, but Asia-focused business. So we'll certainly watch what happens with the London listing. And if we get the same kind of upside that we saw in Hong Kong, what will that do to the London market? So the London market is open, out the gates first, as is usual, up by 0.3% this morning on the FTSE 100. Waiting then for the other markets markets to open up, Lizzie. A sense that the AI story, it's not over. We saw something a little calmer in markets, dare I say even positive for some of the software names that have been so beaten up yesterday. I mean, was that of a dead feline nature? We will find out later on today. Or was it something more meaningful, telling us something important about the way that maybe Anthropic and Claude and all of its plugins will be collaborative and not so disruptive for technology? But that still remains one of the big questions hanging over these markets this morning. So European stocks then opening to the upside, and the IBEX actually getting a pretty strong start to things, up by 0.7%. Lizzie, what do you see?
Well, in the sectoral picture, it really follows the earnings stories that I was mentioning just earlier. Banks are the best performing sector, up 1.7%. And of course, we had HSBC, as I say, beating on profit. Bottom of the basket of food, beverages and tobacco, so down 0.6%. As I say, Diageo cutting its guidance for the second time this fiscal year. So about half of sectors in the positive, just under half in negative territory. And if we look at some of those individual names, so HSBC up nearly 5% in London. Some of the other names that have been reporting this morning, Diageo down 4.2%. Novonesis, we spoke to them earlier on, 2.7% down. Haleon down 4.7%. GSK, I mentioned that agreement to buy 35 Pharma. Those shares actually down 0.6%, and we're still waiting for E.ON shares to open up. But Sandoz was a name that reported earnings. They're up 5.4% after their report earlier on.
We've got negativity around the Diageo numbers. So Diageo's new downbeat guidance points to any recovery taking more time for continued financial pressure on consumers. That, according to Bloomberg Intelligence this morning. So their dividend guidance points to a 20% cut, and a very slow revival is the take from the analysts at Bloomberg Intelligence. And we have the Diageo share price down by 4.6%. So food, beverage and tobacco is the worst performing sector this morning, out of a kind of mixed bag of European stocks. Let's widen the lens, talk to Laura Cuyper, global investment strategist and head of macro credit over at Nuveen, with us this morning. So the perfect voice to join some of the dots around market angst this morning. Laura, really nice to have you with us. So we've come from a period where we were all really stressed about what AI is going to do to software and all kinds of white-collar jobs. And then yesterday looked a little bit different, a demonstration, a showcase of Anthropic's tools, suggesting maybe this is all about collaboration after all, at least in the very first instance. Is that enough to calm your nerves?
I don't think necessarily it's enough to calm nerves, because I think what we're seeing overall is this transition in how investors are looking at the AI theme. Initially, it was all about looking for the upside, looking for those winners, where now the question is around who is going to be most disrupted by AI. If we look at the different layers of this, clearly it's coming through in the digital businesses, that's playing out in software. So I think we're in a phase of price discovery in that sector in particular. We've seen quite a significant re-rating, perhaps not enough though, and I think it's going to be more about dispersion in this space, trying to identify who the winners are, who the losers are, as we continue around this AI evolution.
Yes, and if we're thinking about the losers, what is it that's at stake here? Because you make an interesting point in your notes. You say we're re-rating some of these software names from trading at 10 times revenues to maybe 3 to 4 times revenues, and that might mean that individual shareholders lose out. But where does that pain fall, do you think? Because, does that take us into the land of private credit, into business development companies, into the banks that lend to the BDCs? Where does that, how substantial will that pain be, and where will it fall?
I think that's the key question that investors are trying to navigate now, just what the spillover effects could be. I think at this juncture, we are seeing that pressure valve being in software, but we've seen indiscriminate selling across the board. And to our mind, that's actually creating quite attractive opportunities for those companies that we can see, well, they have proprietary data, they have quite complex workflow systems, they have the ability to really withstand their business models to some of these disruptions. And so those are being re-rated to a significant degree that now presents an attractive entry point. When it comes, though, to the private credit dynamics, to other asset classes, we are going to see more negative effects coming through. But again, pockets of pressure, not necessarily contagion risk. I think the overall fundamental backdrop, looking at the economic fundamentals, looking at the earnings backdrop, still remains relatively supported. So I think that still warrants a cautiously optimistic outlook outlook, looking at the equity landscape and even the credit spectrum overall.
OK, that's interesting, because UBS is basically saying that it's going to start in one sector and then it'll be a domino effect that cascades into other sectors. And the Citrini report saying 5% of white-collar jobs could go in 18 months. Is the market overestimating then how fast the disruption is going to happen?
I think that is the case. I mean, certainly we are looking at markets pricing in the rapid pace of that disruption coming through. But, you know, enterprises take quite a bit of time to actually implement changes. We are seeing workflow processes that are quite embedded. Switching costs for some of these applications are still quite high. So it's not a case where we're going to see this rapid acceleration away from this application layer. So again, I think the dynamics are still there, that we're going to see more price discovery in this phase, but not necessarily this is the catalyst that would warrant a kind of a systemic risk, I would say, more broadly. OK, well, as we have the AI scare trade ebbing and flowing this week, we can't forget tariffs, and President Trump very keen on tariffs still in his State of the Union address. If this prolonged trade uncertainty continues, how much is it going to continue to weigh on the dollar this year? I think that's going to be, again, that key pressure valve. We're already seeing that come through in terms of challenges around U.S. exceptionalism. You know, we are seeing equities continue to be strongly bid, but with increased hedging, so people don't want to take on that dollar exposure. I mean, if we take a step back and think about the current tariff dynamic, yes, we had that SCOTUS ruling, but overall, the effective tariff rate is likely going to be little changed now that we have alternative sources of those tariffs coming through. So from a growth perspective, from an inflation perspective, it doesn't really meaningfully change our forecasts at this juncture. So this really just kind of amplifies this heightened uncertainty dynamic, which markets were already struggling to try to navigate around. So I think status quo really is kind of the landscape. OK, but even but even where we see uncertainty, I think you think it might weigh on the dollar. And I wonder what that means for treasuries, because we've seen treasuries caught up in that kind of de-dollarization narrative a little bit, and others have pushed back against that. But then just more recently with the SaaSpocalypse, the AI tantrum, we've seen actually treasuries act as a bit of a haven after all. And I wonder what that's taught you about the role that treasuries are still playing in markets. So I think the dollar, or certainly the treasuries, can still showcase their safe haven dynamics in acute risk-off episodes. But I think the structural core drivers of dollar weakness and treasury kind of upside on long-end yields still remains in play. If we think about the fiscal impulse is going to be quite sizable, there's uncertainty still navigating this policy dynamic. We also have a number of factors, you know, really when it comes through, it's certain that the demand for long-end treasuries is coming under pressure. I think a lot of the Fed dynamics, you know, the pressure that we could see come through on that front. Are we going to see even more tax cuts come through, which has been alluded to more recently? All of those factors suggest we are in this higher for longer yield backdrop. And so does that mean the Fed narrative will pivot more from, well, away perhaps from job concerns, more towards inflation fears, although, you know, the AI conversation and losing 5% of white-collar jobs sort of speaks in the other direction. Does it bring a hike into play? I don't think it brings the hike into play. I mean, if we look at the recent Fed commentary from Goolsbee, from Collins and others, they're basically saying that we're seeing a steadying in the labor market. So that does warrant, you know, an extended policy pause, which is in line with our view. We are unlikely to see the resumption of rate cuts until we see greater signs of disinflationary pressures coming through, which to our mind is more of a second half of 2026 story. So I think the Fed cut narrative still remains in play. Looking at what markets are pricing, just over 2 rate cuts this year, I think that's largely in line with our view. So it's more a case of, you know, curve steepening, more positioning in that kind of the front end rather than looking at that kind of long end, because we expect more volatility given some of the fiscal and uncertainty pressures. Laura, I wonder what you make of all of this speculation around ECB President Christine Lagarde's tenure, how much it's going to affect the euro. I think the ECB continues to remain data dependent. They've assessed that they are in this good place. And I think if we look at the economic data coming through, certainly from Germany more recently, as we start to see growing signs of that earlier stimulus really making its way meaningfully into economic data, all of that suggests the ECB will continue on their current policy stance around keeping this extended policy pause. our view is that they're probably going to enter a hiking cycle in early next year. So I think certainly the leadership change potentially does add a layer of uncertainty, but this is a very consensus building machine, and I think the data doesn't necessarily support a shift in policy at this juncture.
Okay, Laura, great to have you back. Laura Cuyper, Global Investment Strategist and Head of Macro Credit over at Nuveen. Thank you. Let's check in on the core six this morning. What are they doing? We are looking at Novo Nordisk in the red. Oh, look, it's a mixed bag here. Rheinmetall also in negative territory. Same for Nestle, but gains for LVMH. Up 0.7%. ASML and Schneider Electric also in the green. Let's have a look at some of the individual stocks that we're watching. Charlie Wells is here with that. Charlie.
Lizzie, so we've got some green on the screen this morning following some really positive earnings coming out of HSBC, up nearly 5% this morning. And this really is the story of a turnaround going well. An update there about strength from their wealth unit, about their Hong Kong franchise going well, and some cost cuts that are going to be able to be delivered early. So this is a multi-year turnaround strategy that management has been trying to bring about, and it's looking like it is going well. I want to stay on banking, but I want to go to the back end. I want to go to Temenos. They are a Swiss banking financial technology company. And interestingly, they are up nearly 7% this morning. And this is striking because they've had a strong U.S. strategy on expanding into regional banks. And I wanted to bring this up as well because we've been hearing so much about that SaaS-pocalypse. But this, again, is in that tech space, so could be getting a little bit of a reprieve there. So strong news coming from the front and sort of the back end of banking this morning. Let's take a look at another name that really is getting a lot of attention this morning. That is Diageo. They are down 5.8%. They had some disappointing earnings out this morning, talking about softness in the U.S., talking about softness in China. We know there are trade tensions that a lot of businesses like Diageo are contending with. But something else that stuck out to me from management comments this morning was tequila. This issue that the tequila space that, of course, Diageo is competing in has gotten a lot more competitive. So a lot of red here this morning as they deliver that negative guidance for the year ahead. Now let's take a look at another company that really has been struggling with a turnaround. It is Aston Martin, but you're seeing the flip here because despite the fact that they have had this multi-year turnaround strategy, up over 5% this morning. Now, look, they've got some disappointing earnings. They talked about Donald Trump in a report talking about those tariffs, but we're seeing this increase. Now, this could be related to some cost cuts that they're talking about, a reduction in the workforce of about 20% that could cut costs, but that also comes with job cuts.
Charlie, thanks for those movers. Another one to just throw into the mix, Trainline shares falling more than 8%. This is after the CEO announced that they were leaving, so another one to watch.
You want that kind of response, don't you? You announce you're leaving and the stock drops. I mean, you don't, obviously, but it probably does wonders for your self-belief.
The market mourns that departure. Yeah. Well, coming up, activist investor Boaz Weinstein warns that the wheels are coming off on private credit. So we'll get you more on that story next. This is Bloomberg.
Welcome back. This is the opening trade, 16 minutes past 8. And the European equity markets picture after those 16 minutes looks like this. We've got the stock 600 up by 0.3%. The FTSE is really outperforming this morning, up by 0.7%. We'll get to the reason for that in a moment. Spoiler alert, it involves banks. The CAC 40 and the Xetra DAX underperform a little bit then this morning. The DAX is almost entirely flat, so some real divergence at the index level.
Yeah, when you look at the sectoral level, you've got basic resources leading the gains, banks in second place, hence why London outperforming. But part of the banking story, of course, comes back to HSBC. Its overall bonus pool rising 10% to $3.93 billion, the highest in at least a decade after the bank delivered full-year results that beat analyst estimates. The CEO, George Elderhary, spoke to Bloomberg's Haslinda Amin shortly after the results came out.
Compensation, Haslinda, has to be fair and has to be competitive, but equally has to be differentiated to reflect talent and talent contribution and performance. And we expect this differentiation to continue as we embed the high-performance culture at HSBC. And we expect, therefore, with this compensation structure to be able, as I said earlier, to attract, to hire, and to retain talent
more. Let's bring in our EMEA Finance and Investing Managing Editor, Tom Metcalf. Tom, you got the shares up about 5.5%, both in London and Hong Kong. What's so impressive to investors about these earnings?
Yeah, well, I think it's partly helped by that guidance. And just broadly speaking, if you look at all the results, largely driven by wealth outperformance in some ways. Basically, it does look like HSBC is firing on a lot of cylinders. So, they've basically been able to say, hey, the guidance is going to be better. And there's just a lot more confidence, I think, emanating from management, around, say, benchmark interest rates in Hong Kong, but also their ability to, kind of effectively pledge bigger buybacks, bigger dividends going forward in the years.
And what about areas of concern? The wider markets are very concerned about private credit, exposure to software. Did HSBC have anything to say on that subject, Tom? Is that an area of focus for this particular kind of bank, or is the growth focus elsewhere?
Yeah, I think it's for all banks is a big focus. I think for HSBC, perhaps wisely they didn't get too much into that because it's such an area of concern or of interest for shareholders. But yeah, like all lenders, they are exposed particularly to the BDC side of things, and that is something they're going to have to manage out. I think like the big lenders, there's not it's not crisis mode or anything like that. It's more like, this is another problem we're going to be battling probably in the years ahead.
Yes, because we were thinking yesterday, why was the European banking sector weaker? And today's very different. HSBC is lifting the banking sector, of course. But some people were drawing a link between things Jamie Dimon said about concerns around private credit and what that might mean for the banks who've been lending to private credit. And we've got this chart that I pulled out from a Simon White piece on the Markets Live blog this morning that just shows the extent to which lending by banks to BDCs and other private credit providers has really increased, sort of emphasising where those feedback loops might come from, should we need them.
No, exactly. It's a very stark chart, and that's the thing that's changed over the years, right? Like pre-crisis, this would have been stuff banks probably were doing. Now, of course, you've got all these alt managers coming in and taking some of the bank's lunch. But ultimately, the reality is banks are behind a lot of this. It's the only way it works, right? They're financing, whether, kind of many steps removed or sometimes in some cases directly. So that's why I think banks are quite sort of reactive to these kind of comments. And, you really dig into what Jamie Dimon says. There's a lot of nuance there, but of course the market kind of takes away the bigger picture. Wait, if Jamie's worried, should everyone be worried? So I think probably bank shares will be quite
I feel like he worries
volatile.
a lot. I mean, that's his job. Yeah, bank CEOs are supposed to worry, I suppose.
And give colourful worries about things. Look, the bonus pool rising to the highest in a decade, does that say something specific about the culture at HSBC? Yeah,
well, I think the comments we just heard from El Hedary about this idea of differentiation is what really stands out. So what's happening there under El Hedary is they are basically moving to like what I guess people view as a classic Wall Street model, eat what you kill. Traditionally, perhaps the bonus pool was a bit more spread equally. It was a bit more of a, kind of everyone gets a little piece of everything.
A democracy.
A democracy, that's the word I'm looking for. But no, really what's happening now is more Goldman Sachs now when you think HSBC. So what you are seeing is that pool is rising. But over the coming years, it will sort of all pool towards the real high performers. Because what we are also hearing is, despite the pool being up, there's plenty of people out there at HSBC who are probably going to be quite upset with their bonuses.
Yeah.
We'll keep an eye on that then. Tom, thank you very much. Tom Metcalf, our EMEA Finance and Investing Managing Editor, talking us through the numbers that we got from HSBC and the positive market response to them. Let us think about an area of concern, though, when we touched on it there with Tom, and that is around private credit. UBS has amended its worst-case scenario for defaults in the private credit sector, saying they could now surge as high as 15%. That's 2 percentage points more than previously forecast. Let's bring in our senior reporter, Silas Brown, who's across this story and all things private credit for us. And Silas, I don't want you to take this the wrong way, but the more you appear on TV, the more concerned I am, people are. This is an indicator the market needs to know about. So Silas is on TV as our indicator of the moment. Talk to us about this UBS warning, because, I mean, if all they're doing is taking something that could have happened from 13% to 15%, so it doesn't sound all that stark, but I suppose it's the direction of travel. They are more, not less, worried about private credit.
Yeah, and 15% is, like, very, very high default rates. I mean, certainly, like, historically, it's sort of more like 2 or 3% or 4%. With private credit, though, default rates are always a slightly kind of complicated picture. Direct lenders can recontractualize their lending terms and things like that. There's all manner of ways of getting around defaults. I think the really significant thing is around recovery rates. Like, if a credit goes bad, how much money can they actually recoup? And I think the interesting thing with software and AI is, when you go through these kind of like, sort of sort of these like sort of episodic secular trend things, the recovery rates can be really low. And with software, as an industry which is very asset light, there's not very many like machines that you can kind of
recovery is even lower.
Claw back from. So so I think that's kind of that's sort of interesting to me as well. Yeah.
It's not the only warning, though. UBS coming out with this so soon after the last kind of worst-case scenario. You've also got Danny Moses from The Big Short fame drawing parallels with the pre-financial crisis era. You've got Boaz Weinstein saying that what we're seeing in private credit is the wheels coming off the car. How close are the parallels with pre-GFC?
Yeah, I think it's interesting because, when I saw Boaz's comments, I thought, God, it's funny. The market's really been able to evolve largely without predators, and now you're seeing kind of this world where there's a lot more criticism, there's a lot more public kind of scrutiny of it, and part of that is to do with the scale of, it's a more systemically important business, and I think partly it's to do with, that they are going more into the public view. I mean, they're often public companies, they have retail money that is in some senses public. I think, look, it's very clear that there's been a kind of boom in leveraged lending that is associated with the private equity industry, both in private credit and in leveraged loans. It always interests me, it's a slight tangent, but private credit is a service provider to private equity. And with all of these criticisms about private credit, my beady little eye thinks, private equity is also kind of in a concerning moment. And I think, we as reporters, we need to scrutinise both the credit side and the equity side when it comes to these paradigmatic shifts.
I feel like there was a lot of beating up on private equity over years ago, wasn't there? So maybe it goes in cycles, Silas. Maybe we'll look for some more reporting around that. It was interesting, some of the other sort of mood signals in the market. We had New Mountain Finance. They sold a bunch of assets, $500 million worth of assets at 94 cents on the dollar. But on the other hand, Dan Loeb at Third Point says he's still launching a private credit fund. In terms of the mood music that you listen to, where's your head at?
Yeah. It's like, to me, it's like a Rorschach test at the moment. It's like, you can kind of make of the market what you will. I mean, I think there's, it's sort of somewhat being drowned out at the moment. But, there's positive news around M&A. I mean, this huge kind of M&A logjam, which is kind of busting open with these large transactions. I mean, I still think fundraising for the larger private credit players is pretty strong. But then on the other side, look, I mean, I think the software AI thing, and also AI's impact on all number of all number of sectors that private credit has become very fond of, I think is very significant because it's about it really penetrates the market as it does with private equity as well. And so I think that they're the noises that I'm most interested in.
Yes.
And I also think, by the way, the redemption requests and investor withdrawals and what's going on in the US is very, very key. Yes. It's all about sentiment and it's all about trust.
Absolutely, and that's what makes people go back to 2007 and the like, but we'll see if we ever get there. Silas, thank you very much. Thank you so much for joining us. Bloomberg senior reporter Silas Brown with all things private credit. Now, that takes us neatly back to technology and Nvidia results. Coming up on the programme, we'll get a look ahead at the Nvidia results. They are coming later on today. This will be the next test for the market. The market is skittish around software names, but what about the hardware companies that are supplying this build-out, this data centre build-out globally? We'll discuss all of that next. Pleydell-Bouverie from Lion Trust will be with us. This is Bloomberg.
This is the opening trade. We're 30 minutes into today's session and your markets picture looks like this. Green across the screen for European equities this morning. Particular outperformance in London. Two of the best performing sectors this morning are basic resources and banks, which explains this outperformance. Banks helped by that strong set of results from HSBC. Shares up over 5% on this in London and in Hong Kong. So green over here. But when it comes to the US futures picture, not so positive. Futures weighed down by President Trump. different State of the Union address, it would seem, Anna. What are you looking at under the hood?
Yeah, let's have a look at what is turning out to be already a pretty high volume day for European equity markets, up by 66% versus the 20-day average. So some decent volume coming through. In terms of the split gainers to losers, the fact we're seeing such strength in London, you might think that we'd have more of a positive slant to this split, but 365 stocks higher out of the stock 600. Not everything by any stretch. But let's focus in on some of the positivity that we're seeing this morning. HSBC is one of those stocks that's really on the rise today. That stock up by more than 5%. ASML up by more than 1%, bouncing back after, of course, we've seen that AI scare trade in recent sessions. Yesterday was not too bad. Yesterday for ASML. And Nordex in focus up by 11.6%. Had some good numbers out of that particular business. Let's go to the consumer company that is Haleon. Their numbers are disappointing this morning, down by 3.6%, it would seem, for that particular business. Auto One Group also in focus, and that stock down by 8.3%. L'Oreal down 1.2%. They are one of a number of businesses that's filed a lawsuit for refunds of tariffs paid under President Trump. Lizzie?
Let's look at what else we need to know this morning. President Donald Trump offering a defiant defence of his policies and economic record, declaring the nation is back, bigger, better, richer and stronger than ever before in his annual State of the Union address. The president staged his version of a pep rally ahead of the November midterm elections. With Supreme Court justices sitting close by, the president criticised their recent tariff ruling and said that levies were essential to boosting US finances. Elsewhere, yields on Japan's longer-term bonds climbing after Prime Minister Sanai Takaichi's government nominated 2 new Bank of Japan Policy Board members. The naming of 2 academics associated with reflationist economic policies is likely to fuel speculation that Takaichi will be cautious about the central bank raising interest rates quickly. And earnings. Diageo cutting its guidance for the second time this fiscal year as the British distiller struggles to revive demand in both the US and China. The company also announcing it'll also reduce its dividend, with the new CEO Dave Lewis saying that he's working on an updated strategy for the group that he will reveal during the third quarter. Anna.
So those are some of the corporate stories we're focused on right now. Looking ahead, we're going to be focused very much on Nvidia. The disruptive potential of AI has shaken stocks across multiple sectors over recent weeks. So next up in this saga, we have earnings from one of the companies that makes some of the hardware that is involved in the AI build-out. And that, of course, is Nvidia, the world's most valuable company. We're joined now by Claire Pleydell-Bouverie, fund manager at Lion Trust. Claire, really nice to speak to you. So much to discuss this morning. Let's look ahead to the actual numbers there and what we expect to hear from the business. So revenue estimates out there around $65–66 billion. You think that the market is underestimating what Nvidia is going to deliver and the positivity that they might add in their 2026 outlook. Why are you more positive?
Morning, Anna. It's great to be on. So we think that 2026 is going to be the year where we see an acceleration in Nvidia's beat and raise cadence. We actually think that we saw an inflection point in Q3. Throughout 2024, Nvidia was beating its own guidance almost like clockwork by about $2 billion. The first half of last year was obviously compressed because we lost China. That snapped back in Q3 and the company beat its own guide by around $3 billion thereof. We did see a little bit of positivity. It didn't last very long with that reversal. But as to why we think this is an inflection point, really 2 reasons. First, demand, which just continues to be underestimated, both in terms of the magnitude and the durability. I mean, if we just take one portion of that demand, the hyperscaler CapEx budgets, the sell side have got hyperscaler CapEx growth wrong by an order of magnitude. I mean, 3 to 4 times for 3 straight years. At the start of this year, they were expecting growth of 19% year on year. We've actually got 67% year-on-year growth after those companies reported. But more importantly is the fact this demand pipeline is broadening for us. So agential AI is at a tipping point. You've only got to use Claude Cowork for one day in order to realize this. And obviously, yesterday we heard from Anthropic that you can now build your own customized agents using Claude within the enterprise. So we think the enterprise AI is about to take off.
OK, so all of those things that you know, your bull case around Nvidia, the share price has gone nowhere really over the last, well, certainly year to date. It's underperformed the wider market and the last quarter of last year as well. What can they say to kickstart this? I mean, is it about talking about the level of capex that they're seeing those hyperscalers doing, or what is the message that's going to make a difference to this?
Sure. So we think that it's not really an issue about the numbers. Last quarter, we saw fantastic numbers. The it's more sentiment driven. And we think that two things will help here. First of all, the TPU versus the GPU debate has really weighed on the stock price over the past 6 months. We think that Rubin really changes that. The TPU version 7 Ironwood rack is genuine Blackwell class competition. Rubin changes that.
And that comes the second half
That comes in the second half of this year.
Right.
5x more compute, 3x more memory bandwidth, 3x more chip-to-chip interconnect. But the other part of that is we're going to see the first models trained on Blackwell coming to market this year. So every single NVIDIA-trained model to date, whether that be from OpenAI or other large language model providers, has been trained on Hopper. And we're expecting a significant leap in model capabilities from Blackwell. And that will just reignite the flywheel again.
You mentioned the Anthropic news on Claude and just how impressive it is, really. There's also the Citrini report, right, saying that 5% of white-collar jobs could go in 18 months. Given that you are so impressed and enthusiastic about what could be done by AI, how much comfort should that Anthropic narrative be that it's going to integrate rather than displace jobs?
It's an excellent question, and we obviously don't know the clear answer right now. But the doomsday scenario that's been portrayed in some of these reports, that we're going to have a consumer-led recession in the US by 2028, there is simply not enough compute that's going to be available in that scenario for that to happen.
Oh, that's really interesting. So the thing that saves us from doomsday is not enough computers.
Essentially, yes. I mean, if you read the transcripts of NVIDIA's entire supply chain this quarter, from the optics providers like Lumentum to TSMC, they're sold out. They're completely sold out. And so that is going to be a constraining factor. The other point is that, with these technology platform transitions, whilst there is always job displacement, and probably the only comparable transition to AI is electricity, in terms of the impact it's going to have on the economy and every single sector in the economy. There's job displacement. There's also creation of new jobs. I mean, in Silicon Valley right now, there are new jobs that didn't exist 2 years ago. Prompt engineers, inference optimization experts. So we do think that there will be some good news in this as well.
OK, well, staying with the positivity, we were just talking about all the worries about private credit, but you say that the AI credit risk is low, concerns about circular financing are overblown. Do you still think that there will be cockroaches in credit because of AI? And where do you think that they'll be? Because we've got the warnings piling up. UBS, Danny Moses, Burroughs Weinstein, we were just talking about all of them. Sure. No, we think there's... Well, there are two aspects, really, to AI credit risk. The first scare was with the hyperscalers, and we don't think this is a risk. These are the strongest balance sheets we've ever seen. Assets to liability ratio for 50% for the big five. That's in comparison to the S&P at 80%. So we're not concerned about these companies taking on debt to finance their AI infrastructure build-out. The reason because that is that we're seeing a very tangible ROI on AI. These hyperscalers have been through a build-out before with the cloud. That turned out to be a very good idea. It took about 7 years for those CapEx investments to become profitable, but they built $600 billion annualized business out of that. The credit risk, as you rightly point out, Lizzie, we think is going to be in those private credit and loans exposed to legacy software, because that probably goes some way to sort of portraying our view on legacy software. We think that there is going to be a lot of disruption there, and about a third of private credit on our research is exposed to that disruption risk. So the market's looking at this risk. We certainly do see risk in private credit.
Yeah, so risk in private credit attached to that software. And in terms of a re-rating of software, is there a rule of thumb, or do we have to be more discerning and just take each individual business as it comes? I mean, we talked to Laura Cuyper from Nuveen earlier on. She was saying that maybe it makes sense that we re-rate software down from a 10 times revenue kind of valuation down to 3 or 4 times revenue. I mean, what's your rule of thumb when it comes to the software sector and what it's going to face?
Sure. So we divide software between two categories. Software 1.0 built on and for traditional compute, software 2.0 built on and for accelerated compute. The vast majority of today's incumbents are software 1.0 companies, and we would be very reluctant to have any exposure there. We don't think that we've reached capitulation levels there, because you're seeing new competition coming to market in AI-native startups. That compresses your top line. We think you've then got margin compression on the horizon, because agentic AI burns compute with every prompt, every query. So we think that gross margins have got to compress from about 75 to 90% all the way down to 50 to 60%. And then, to your point, Anna, you see multiple compression, because we've been willing to pay up over the past decade a premium multiple for these companies because of those recurring revenues. That's no longer a certainty. So we actually think there's probably further derating to come there for 90% of the software company.
Claire, I want to end on what you say is the biggest opportunity of all, physical AI, because we've got an interview to play in just a moment from the CEO of Wayve. So this includes, robots, autonomous vehicles, industrial machines. How big of an opportunity is that, and when are we going to start seeing it showing up in earnings?
Sure. So physical AI, if we think about Nvidia, none of this is priced into the stock. This company is priced as a data center company. Yeah. Essentially, every single robotics company, autonomous driving program is building on Nvidia. And the reason this is the biggest opportunity of all is that it's threefold. You need your training compute in the data center. Think of that as sort of training the robot's brain. You then need digital twin infrastructure and simulation to teach the robot, so it doesn't do anything scary in the real world. And then you actually need silicon on the robot, the device, the car for edge inference. And Nvidia's built the whole stack. No other company offers that. So you can think about every single company, whether they be in general industry, whether they be in the automobile sector, and that's a much larger opportunity than software. When do we start seeing this? Well, autonomous driving is the first use case, and we think that's going to start to inflect over the next 2 years. Beyond that comes general industry. We think this is going to be a very big market by the end of this decade.
Claire, it's always fascinating having you on. Claire Pleydell-Bouverie, taking us through the future. That's the fund manager at Lion Trust, Claire Pleydell-Bouverie. Thank you. Well, speaking of those autonomous vehicles, the self-driving software company Wayve has raised $1.5 billion in new funding. Microsoft, Nvidia and Uber are among those investing in the Series D round, which brings Wayve's valuation to $8.6 billion. The company is due to begin commercial trials of its software in robo-taxis with Uber this year, and the CEO, Alex Kendall, spoke to Bloomberg Tech Europe's Tom McKenzie.
This raise for us is one that's hugely validating for our approach. We've got ecosystem partners from some of the best in the capital markets, partners throughout the tech ecosystem, and of course 3 of the largest OEMs, largest car companies, backing us to now move into a phase of commercialization.
And how does it shift that effort to scale commercially your technology?
Well, look, I think it's clear that autonomy is now coming to market in a massive way. But there are 3 different business models you can choose to bring autonomy to market with. Of course, you can try and sell your own car. You can try and operate your own robotaxi service. But we've chosen the largest business model of them all, which is licensing our embodied AI software to fleets and automakers around the world.
And you've had your partnership with Nissan over in Japan. Now you have Stellantis and you have Mercedes-Benz as investors, but also as commercial partners as well. What is the nature of those deals? Are these pilot deals or these full commercial deals that you have now with Stellantis and Mercedes?
Well, this is fantastic. We're so excited about deepening our relationships with these 3 automakers in this round. They've been really great partners to us. And across all of them, you have 3 of the 10 largest automakers there from Europe, Japan, North America, spanning mass market to luxury vehicles. And this really demonstrates the breadth of capabilities that our AI has. But we're excited to be working with them all towards not just consumer vehicles that you can buy, but also robotaxis. We work with the cars they build, work with the embedded hardware they have, and make sure that our AI has the intelligence to drive their vehicles. How do you mass manufacture these robotaxis? We're not retrofitting, which is capital intensive and slow. We've got a high margin software licensing business that works with the very largest manufacturers in the world. And so I think these are the questions to be asking about how this technology scales, because the KPIs are going to come. The rate that our AI is learning and increasing in performance is only accelerating with the more deployment exposure.
And to your point, you've also made it clear that this is a software-first approach. We've seen a massive sell-off in software stocks as a result of the disruption from AI. Has that led to any questioning that that is the right approach? Have you had any investors putting pressure on in terms of proving that you can be generating recurring revenue and profitability?
I don't think anyone is questioning that autonomy is going to be in every vehicle in the future. I think that's very clear to the market now. Every vehicle is going to be autonomous. The question is, what is the right technology strategy and what is the right business model?
And you'll have pricing power.
100%.
That was the Wayve CEO, Alex Kendall, speaking with Bloomberg's Tom McKenzie, of course. Now, coming up on the programme, we'll focus back in on the State of the Union address. President Trump touting a strong economy in his State of the Union speech. That was his take. There are others. We'll dig into the details next. This is Bloomberg.
Our nation is back, bigger, better, richer, and stronger than ever before. I used these tariffs, took in hundreds of billions of dollars to make great deals for our country, both economically and on a national security basis. Almost all countries and corporations want to keep the deal that they already made, right, Scott? Knowing that the legal power that I, as president, have to make a new deal could be far worse for them, and therefore they will continue to work along the same successful path that we had negotiated before the Supreme Court's unfortunate involvement.
That was President Trump talking about tariffs during his State of the Union address, laying into the Democrats, things we know very well from him, and talking for longer than is normal, perhaps, at the State of the Union. One thing that President Trump kept coming back to was the economy, saying that everything is going great, glossing over perhaps some affordability concerns with statistics and self-congratulations. The president boasted that inflation is plummeting and incomes are rising fast. He did talk about affordability, but the ways he was going to tackle it were in focus for him. Let's get to Bloomberg's Washington Deputy Bureau Chief, Laura Davison, who's with us now. Laura, your takeaways then from this State of the Union address. It didn't seem to me to be moving markets all that much in the moment, but having had some time to digest it, what do you think market participants will take away from it?
Market participants were looking for some new policy ideas, and that just wasn't what the speech was about. It was really a backward-looking speech. Trump was touting his economic agenda, saying that the economy was on the right track, something that's not always supported by the data. He talked about his tax cuts from last year, but he didn't have a lot of ideas for this year of going into the midterm elections, kind of giving Republicans some of those talking points that they could talk about with their constituents as they are back in their home districts running. The only idea he really brought to the table was a policy to add retirement savings to some workers who don't have employer-sponsored plans. This is actually an idea that was passed under President Biden in 2022, set to go into effect next year. So there were very few things that were original and novel for Trump to really kind of set the stage for what he wants to do with the remainder of his term.
Laura, where the president predicted that the US is going to take in so much tariff revenue that it will replace the modern-day system of tax, should the market interpret that as more tariffs to come?
It can certainly be interpreted as a sign of more tariffs to come. Trump was very direct on that, saying that he was not deterred by the Supreme Court's decision and would continue to impose tariffs. He said it would be more complex, but that perhaps it would be better. He also told members of Congress there sitting in the room he wasn't going to ask for their approval. He was going to act unilaterally. Trump has repeatedly talked about this idea, really going back to the 2024 campaign trail, that he was going to, eliminate income taxes with tariffs. Just the rate of tariffs you would need to have and the amount of tariffs you would need to have on different goods would be so astronomically high that economists have really discounted this idea that you could replace income and corporate taxes with tariffs. It's just an idea that when you kind of look down at the math, it really can't happen.
OK, Laura Davison, Bloomberg's Washington Deputy Bureau Chief, thank you so much. Well, for more on the market reaction, let's speak to Skylar Montgomery-Koenig from our Markets Live team. She joins us now. Skylar, as we heard there, not a whole lot of new policy, a pretty tepid market reaction. What is the most important thing for markets out of this speech?
I mean, I think it's just the message that we've had all along, that tariffs aren't going away. Now, it's really interesting that the market seems to take these tariff headlines or kind of erratic policy making in different strides at different times of the year, as in at the latter half of last year, we had moved on largely from this policy noise. There was an acceptance that tariff rates would stay where they are, and we were getting to a point where you had some level of certainty. Now, you had more kind of gyrations at the beginning of the year, but I think the most recent reaction tells you that you're once again moving past that in terms of you're going to have tariff rates that are relatively high base level. The U.S. economy has done okay within that backdrop, especially considering that you've got fiscal policy that's becoming looser this year, particularly this quarter. You're going to get a bounce back in GDP because of that, as well as the distortions from the shutdown coming out. And so you can be okay in equity markets. You're not going to get these kind of big negatives from tariff headlines.
And to kind of thinking about equity markets, we've got Nvidia numbers coming up. We have been preoccupied with thinking about tech from a different angle recently, which has been about the damage that AI might do to certain highly valued software companies. And now we're going back to thinking about where this kind of all started, which was the data center build out and the opportunities that exist for companies like Nvidia. What are you watching for then as we go into this really important earnings story?
I think it's very key how the market takes it, because year to date we've had a market environment where beneath the surface there have been these kind of landmines that have gone off around certain companies being worried about disruptions from AI taking over software. Maybe it's you're spending too much and that doesn't result in profitability. Maybe it's your margins are going to be compressed by the fact that chips are more expensive. But we keep having these headlines that are quite scary. And we may have hit that kind of peak angst with the report that was released yesterday, or I think earlier this week, talking about the worst case scenario and that creating quite a decent market reaction despite the fact it being more an extreme scenario. So if we do get past Nvidia earnings and it's a more positive outlook, then I think we get a rally on that and you can be more positive generally, even if you still get gyrations below.
Just very briefly, Skylar, because I've got to get it in before we can't talk about the Gorton and Denton by-election happening in my hometown of Manchester. What's the worst outcome for markets, gilts and sterling in particular? If you have reform and it sets up more a headache for Keir Starmer later, or the Greens winning, as the betting odds suggest, and that pulling the Labour Party to the left?
Yeah, I mean, I will say as a starting point, there's very little fiscal risk premium priced within the pound or gilts. We had an understandably positive reaction to the November budget, and so downside risks are quite large, I think, going forward for Keir Starmer, whether it be from tomorrow's election or later on. I do think in terms of the party, we know that the Greens are more likely to fiscally loosen the reins, and the market's more concerned about that sustainability than anything else. That's what we've seen over and over again in the UK. And we don't really know the extent to which you'll get this kind of fiscal loosening from reform. So that's where it leaves us.
Skylar, thank you very much. Skylar Montgomery-Koenig with the Markets Live team view, or her view from the Markets Live team. We have, I was going to say, a busy day. We have a day of many parts ahead. The Nvidia earnings we've talked about, US earnings. Tariffs will still be in focus, though President Trump keeping those on the agenda with State of the Union. So we will be hearing from the US Trade Representative Jameson Greer. That's at 1:30 p.m. at UK time. Don't miss that. Worth noting that US futures are a little bit firmer right now as we work our way towards some of the key tech earnings of the season. Nasdaq futures up 0.2%. This is Bloomberg.